Good morning, everybody. Thanks very much for joining us. My name's Richard Betts. I'm the publisher at Real Asset Media, and this is one of a series of events that we're running focused on various different topics. And this morning, I'm really pleased to be covering European debt finance and investment, looking at both sides of that in terms of the borrowers, but also the investors in debt. We've got Carsten Loll from Linklaters, Norbert Kellner from Berlin Huepfl, Emma Huepfl from CBRE Global Investors, Jonathan Lai from Auxilium Financial Risk Management, and last but not least, Anthony Shayle, who after kind of 35 plus years is currently an independent consultant looking at this area. So lots of expertise on the panel, lots of different views. So very, very pleased that you're joining us today. Just in case you don't know who we are, we run a series of events, newsletters, magazines, TV, a lot of interviews, and we've also launched a couple of new initiatives because of the health crisis, whereas before we were well known for sort of doing 60 events a year, traveling all across Europe as well as the US and Asia, going out to visit people and connect those communities together within the industry. We've moved that all online so that you can join from wherever you are in the world, and that includes wherever you are in terms of a speaker as well as an attendee. We've also launched a series of special reports, in-depth analysis. The first one looked at the coronavirus and the impact, and we're going to have another one coming up at the end of June that picks up on sort of where we are as the dust begins to settle a little bit, and looks at where the industry moves forward and rebuilds from here, really. So first of all, what I'd like to do is just introduce the panel. Maybe if we start with you, Emma, just kind of a brief introduction of yourself and the company, just so that then everybody knows exactly who everybody is.
I'm Emma Huepfl. I'm Managing Director of CBRE Global Investors Credit Strategies in Europe. CBRE Global Investors is a real estate fund management business with 113 billion of assets under management. I joined last year when the company I co-founded, Laxfield Capital, was acquired. We're currently working on new debt investment strategies in EMEA to supplement the funds that we already offer in credit in the US and in the UK. I also chair the trade body for the real estate finance industry, CBRE Europe, and for the purpose of this webinar, I've been asked to give the UK perspective on the European debt markets.
Super, thanks very much. Carsten.
Yeah, good morning. It's Carsten Loll from Linklaters, real estate transactional lawyer based in Frankfurt and Munich, and I was meant to be the host this morning. So I definitely owe you a breakfast once we are all able to have one together, hopefully very soon.
Great, thanks very much, Carsten. And may I say what a fabulous breakfast it is. So I should be looking forward to that next time, Carsten, and I will definitely hold you to that. Great, Norbert.
Yeah, hello, my name is Norbert Kellner. I'm with Berlin Huepfl. I used to work in several, let's say, positions, mainly in the syndication part of the business at HSH Nordbank and at Hellerber in Frankfurt, Hamburg, and London. Now I'm in Berlin. Berlin Huepfl is a mortgage bank in Germany, quite among the first, let's say, mortgage lending banks in Germany, with a balance sheet of 27 billion euros. Our key markets, of course, are Germany, but also some neighboring countries like France, the Netherlands, and Poland. And we're focusing on senior loans, and more than happy to give an insight in these markets, or for these markets, and in particular for Germany.
Great, thanks very much. Jonathan.
Morning, I'm Jonathan Lai. I founded Auxilium Financial Risk Management about 2 years ago to give independent financial risk management advice to real estate investors. That's focusing on interest rate risk and foreign exchange risk, and also inflation risk from time to time. I also work with Nordcap, who produce a Swedish company who have a treasury technology platform for real estate investors.
Everybody, my name is Anthony Shayle. I was previously with QBS, where I was the head of real estate for EMEA ex-Switzerland. We had a debt fund that was in the UK. We had approximately £140 million of lending that we placed through the platform. We were looking at expanding, but obviously for various reasons and current situation, that doesn't seem going ahead. Currently, I'm an independent consultant looking at doing restructurings and refinancings for interested parties.
I suppose let's pick up on some of the key kind of topics around where we are in the market at the moment. I mean, I suppose let's start with you, Norbert. Just in terms of the current market, how are you seeing this at the moment, particularly the impact of coronavirus, and is it having a significant, I suppose, impact on the financing markets? What's your sense of that, particularly looking at Germany, I guess, and continental Europe?
Out of doubt that COVID-19 has a huge impact also on our business. I would say that with the first quarter of this year, which was quite good, to be honest, we saw, I guess, all this hefty jump down in Q2 due to the shutdown, in line with the shutdown and all things around. It is in a way that, of course, in my opinion, at Berlin it was very much the same what happened everywhere. That all the banks, all the lenders, all the investors needed during the first weeks, maybe 1 or 2 months of the shutdown, to just check where they are. Right? They had to have a look at the portfolio. They had to have a look on their current projects. They needed to figure out if they can proceed, if they need to put things on hold, if they even have to stop things. And again, we did very much the same. After these, again, weeks, maybe even 2 months, I would say we never shut down business really, but we were, of course, much more careful, very selective in the way. And I would say the next key point was to really communicate with our key investors to make sure to get their view and also to see what their measures are, and then of course to get together and to find out what the right way is to proceed. Outlook is of course very, very difficult, but under, let's say, a positive view, and we try to be, of course, optimistic. We see that there will be some kind of recovery over the next 1 or 2 decades, but it is again very hard to predict for various reasons, and I guess we come back to the potential outlook and impact on the economy later on. But I would say this is definitely a massive stress for the market. It's definitely, for my opinion, also something which will accelerate a few structural changes we could see already beforehand. So it's definitely a time where we again have to be very cautious and have to be very careful in what we do and how we do. And it's definitely nothing which will stop over the next month. We will definitely see a huge impact, not only this year, but very, very likely also the following year.
Good, thanks. And Emma, just in terms of the, I suppose the UK markets, slightly behind Germany and continental Europe in terms of the impact of the virus. What are you seeing here? One thing I must say to everybody is that I haven't mentioned this. When Carsten said we would normally have been in his office, he is actually in his office. Which I found very refreshing, sitting here in London, still holed up in North London, that somebody was back in their office. So I just wanted to mention this is the first time since the start of the crisis that we've had somebody on one of these events where they are actually in their office. So I just wanted to mark that. Anyway, apologies. Back to you, Emma.
So what are we seeing? I would concur absolutely with Norbert on the need to re-underwrite your whole loan book and communicate with every borrower on every position. That's been a huge exercise, and we've tried to put in place solutions where needed in terms of covenant waivers for 12 months rather than lurching from quarter to quarter with temporary solutions. So that has largely been done, and we've had actually full interest collection on the first quarter. So that has been, a big tick in the box. And takes us through more confidently to the next phase. On a wider basis, what are we seeing? Well, investment turnover has really reduced to a trickle, so finance demand, acquisition finance demand, is right down at the moment. There is a market for debt from opportunistic buyers and for refinancings where perhaps an incumbent lender isn't able to fulfill borrower requirements. We've reviewed 32 financing requests since the corona outbreak, and that reflects a lot of exploratory situations, I think, on both sides. We've quoted terms on 8 of those, and we have seen competition in those situations. So that indicates to us that financing is available. But overall in the UK, we expect much lower activity levels than the 44 billion of financing which took place in 2019. So that's a complete turnaround from our expectations in January or February when we thought it would be an active year. But there are always things to do in debt. And, you know, from an investment point of view, terms have swung very much in favour of lenders, both from a pricing and covenanting position. But with so much uncertainty, we're still very cautious about that risk-return equation, as are many other investors. But of course, with lower competition, there's an opportunity there for those who specifically seek to invest in those times. So a mixed picture.
Okay, interesting. Thank you for that. I'm going to launch a couple of polls throughout the session, just so that we can get a sense of that, and also it'll get an idea in terms of what you're thinking, and we can then maybe pick that up in the discussion as well. And thanks, I can see there's some Q&As coming in, so I'll make sure that we also deal with those during the session. Carsten, maybe just picking up with you, looking at the kind of current market, what have you been seeing in terms of deals coming through, and activity, and I suppose how much that has or has not used debt?
Yes, and I think the first thing is, yes, I'm back in the office. I'm not the only one back in the office, so there is a couple of people here. We are not completely full, but we are starting again. And even better, I went for lunch and dinner even during the last week and saw clients. So I think there is a way out, and that should give you some positive sentiment as well. I know you're a bit behind in London or the UK, wherever you are now, but it's just a matter of maybe 2 or 3 weeks, and you will see some normality as well. And I think all our markets need a certain basis of normality. And yes, it all works nice and fine to work from home and to keep things going, but to get new deals kicked off and stuff like that, I think we are still human beings, so we need to have first certainty that this is still the world that we are living in, and secondly, you probably need to meet people now more than before, because you need to build up that certain element of security. You want to feel safe, and you only feel safe once you see other people. So yes, I mean, basically you share the view. We had to look into every single contract that was on the table over the last couple of weeks to see what is possible, what is not possible. However, nothing really happened. So we did many memos, but no one pulled out of a deal, no one terminated anything. So everybody wanted to get prepared, and they're not prepared, but then things turned to be better and nothing really happened. In terms of deals, we completed what we started, and yes, it was a very good Q1, so there was a lot of activity in the first half of the lockdown, I would say, and then something extraordinary happened. I was instructed by Union basically to buy a large object Ericus contour in Hamburg from Patricia during lockdown, basically. So we started a transaction during lockdown and we completed it during lockdown. So I did things that I haven't done for years, reviewing lease agreements in original myself, because I couldn't ask anyone to fly to Hamburg, so I did it myself. And that was really scary. I mean, it's once in a lifetime, but I was in the flight back from Hamburg to Munich, and I was one of 6 people on the Hamburg airport. So because there were 6 people on the flight, but I was on a plane last week as well, and this was fully booked. So things are changing. You are able to start a transaction and to complete a transaction in lockdown, and I think we will see some normality in the second half of the year. Yes, this will not be as 2019 or 18 in my eyes, but given where we were 10 weeks ago, there was bigger issues out there than getting to the numbers where we were last year. So I think there is a good chance that we will all overcome it and take it from there. What concerns me a bit is that people get overly optimistic and that they do not keep social distance. Because if you go out here and you see them, you have your doubts. And I hope that does not create further problems later this year.
Thanks for that. Anthony, I'm just going to come to you, but just before I do, I'm going to share the results of that first poll, which is interesting to see. So the question, just a reminder, was, do you think fundamentally this is a good time to invest in real estate debt? And it was 71% saying yes, they thought it was a good time, versus 29% saying no. And actually, as the numbers built up for that, that's approximately what it was through the whole time. So it was approximately a kind of 70-30 split. Anthony, I just wanted to come to you just in terms of this crisis and how you're seeing this in comparison to the global financial crisis. What's your sense of that? And also maybe just give a first reaction to that poll.
So I think the initial comment I'd make is that from the point of view of what we see as different, people have used the expression, this is a black swan event. That is generally absolutely right. We couldn't have predicted this. Some commentators might have been able to predict the GFC. Certainly wasn't me. That was a complete surprise. But that said, the consequences of GFC were far more predictable than they are today. We sit in a timeline now where vaccinations and antiviral treatments are not on the horizon as we speak, and therefore the difficulty is to predict when the normality can return and in what shape or form. So I think we have a very different situation. It is a completely random event. It has been one that has no obvious solution in terms of what causes it. And absolutely, where we go from here is, in fact, an element of uncharted water or uncharted territory. We don't have a map, in other words. In terms of the poll, I think is absolutely right. I think investors are on the hunt for yield. I think the debt investment environment represents an opportunity for investors to select risk-return characteristics that provide a premium to the fixed income model and a volatility dampener against the real estate model. So I think it does provide investors something they need or would be looking for at this point in time.
Jonathan, I just wanted to come to you. There were discussions late last year about interest rates beginning to tick up, and then that all changed. And now we really do look as though we're going to be in a significantly lower for longer interest rate environment. First of all, what do you think the implications for that are? And does that make debt more attractive?
To start with the initial premise that we're in an environment of lower for longer, it's something that I would also question slightly with the massive issuance of government debt. Will it lead to actually an increase in interest rates when there's such a large supply of debt on the market? There is, of course, the caveat that in the UK's case, the Bank of England has stepped in as a buyer of last resort. And we saw just the other day a bond being issued, 3-year bond being issued at just a negative interest rate in the UK, which has started to change the picture. The Bank of England has also stated that they are now reconsidering how they may use negative interest rates as part of their monetary policy, which, of course, in Europe has already been used. The ECB has used that. And there are lots of debates as to whether that's a good thing or a bad thing. Just looking very specifically at debt and real estate debt, whereas previously there's been an implicit floor of zero in UK debt, and often in loans you'll see LIBOR defined as zero if negative. The the implications of that statement now have to be really quite carefully considered by borrowers, and the cost or the value of that particular instrument, the floor in the debt, has to be thought about as well. And again, whether it's the right thing to be passed on to borrowers, whether a negative interest rate environment should be passed through. So I think it raises some interesting questions, and perhaps even kind of the question around investing in debt as to the potential for that to be worth less than you've actually invested at the start.
We're getting quite a lot of questions coming in here. So I'll just pick up this one because it looks around the sectors, and of course everybody else can come in with their views on this as well. Thank you, Rekatura, for this. What's the change in financing quantum for secondary assets since the lockdown? How does this impact different sectors, office, hotels, retail?
Yes, the question about the secondary market and then the pricing on the secondary market, of course, a bit difficult at the minute, due to the fact that I would definitely say the impact on the syndication markets in general, on the secondary syndication market, is, of course, at the minute quite intense. I would answer that question in a way that I say, I mean, definitely there is liquidity in the market. There's liquidity in the market, so there is interest in buying into loans. Primary as well as secondary, as I would say, even if I would say with a focus on the primary syndication markets. In regard to the different asset classes, that is, of course, a huge, let's say, difference on what we're talking about. And I think that's maybe also one comment on from my side on the poll, when we said, there's a majority thinking it's a good time for investing in real estate. I would in general underline that and would say, yes, absolutely correct. But you have to, of course, differentiate between the different asset classes. And in my view, we will definitely see, you can say, winners and losers in regard to the asset classes in real estate, due to the fact that the impact of COVID-19 will be, of course, massively, from my perspective, when we're looking at hotel and hotel financings, which I think are definitely under stress. There is a huge expectation that sector will have really a lot of difficulties, because of the impact of the pandemic. When you look at retail, for example, you really have to check what kind of retail you're looking at. In Germany, we, for example, finance and still finance with success retail parks, which we think are definitely able to cope with that crisis quite good. Also, the areas of let's say, very good and well-located shopping areas. When you look at some of the, let's say, shopping centers, which are, of course, or which have been also before COVID-19 under massive stress because of the structural change. That's what I mentioned when I said there COVID-19 has definitely a very accelerating, let's say, impact on this negative trend from my perspective. And in that regard, for financings for those assets, it will be definitely much more tougher. And in that regard, I expect a massive negative impact on secondary markets for those loans. So it's really not always the same picture. You really have to look carefully into it. And then, of course, maybe my last remark, these old real estate thing about, are we talking about A locations? Are we talking about more C locations, B locations, areas where it's getting a bit thinner in regard to demand? I think this is definitely the crisis where you have to look also at this. So whatever you do, you have to check in which areas you want to finance. And therefore, when you want to participate in loans or invest in loans, you have to ask yourself, are these financings given in let's say for properties in these very good locations, or in locations where we expect a bigger negative impact?
Norbert, I'll just add a couple of comments to that, if I may. Absolutely agree with everything you've said. Perhaps just a couple of things, that when liquidity gets stretched, it tends to get focused, or strained, it tends to get focused on the better borrowers. So in this situation, liquidity will be much harder to come by for perhaps poorer regional assets and borrowers who don't have are as well capitalized. I think the other thing we may see is that for good assets, but in impacted sectors, there will be a requirement going forward for interest to be cashed up for a very substantial period to protect against future closures. So I could imagine that being an ongoing change that will affect, for example, hospitality or retail assets. But I think generally speaking, it's just very difficult to take lending opportunities to credit committees at the moment if you're in an impacted sector and your asset is either closed or may suffer ongoing issues.
No, I think I agree. I mean, it kind of accelerates a trend that we've seen before. Good assets, good tenants in good locations are interesting. They remain interesting, but then and good borrowers could buy them, but they do not necessarily need banks for that. So that's one half of the market. And the other half of the market, or it's not the half, but it's the other part of the market better, wasn't really there before. So and that's not there either now. But I think this acceleration process kind of can and will create opportunities that were in the market, because if you have some real fantasy and you buy warehouses or clothing stores that are going to close because they couldn't sustain before and they do not anymore now at all, then this creates space somewhere, but you need real fantasy, and that might drive you into in the hands, to say so, of some of the debt funds that got raised in the last years, because that requires a different appetite for risk also from the financing perspective. And that's maybe the change in the market that we will see over the next couple of months, and that can be interesting for some of the investors.
I'm going to launch another poll here, just to check a couple of things, just in terms of how you see debt ranking. So does debt rank favourably on a risk-adjusted basis against, and the ones we've looked at here are corporate bonds, real estate equity, and real estate public debt. So I'll just pick that up, and maybe just coming to you, Emma. Some of these we were looking at a sort of increase in interest in debt, particularly from investors in comparison to other asset classes. What's your sense of that at the moment? Do you think that it really is a safe haven as people were looking at it before? Do you think that's still the case now?
I think it's a bit simplistic to call debt a safe haven investment, because debt carries a whole range of returns from 2% to 20% plus. So I think it's a misnomer for the asset class as a whole. Right now, I think there is good value in core senior, which is normally very commoditized and crowded, but the returns there will be too low for others who would want to pursue a much more opportunistic strategy. And debt for them may even be a point of access for equity ownership. The sad fact is that money will be lost on some well-structured and well-underwritten deals in this cycle, particularly in retail. The talk of 2030 coming in 2020, and some hospitality businesses may not survive. So no asset class is going to be entirely immune from this event, but there is a lot of mitigation in debt, in that there is strong interest cover due to low interest rates and lower leverage overall in the market. So I think it's better placed to withstand the current situation than it was in the GFC. And if you're coming into debt now, you're coming in off a lower valuation basis, and obviously you have, you've got the cushion that exists between a debt position and an equity position, which will allow it to withstand further valuation shocks. So I think to that extent, debt does offer protective characteristics in this environment.
Just coming to you, Anthony, I mean, where do you see, I suppose, the opportunities for debt at the moment? Do you think that's more in the kind of senior debt space? Do you think it's more, do you think people are going to be looking more at distressed? What's your sense of that?
That's a really interesting question, because the point that Emma was making just before is absolutely right. It's a much less crowded market for lenders, and therefore players who are, shall we say, more expensive are likely to be active in a much greater sense. I think where the opportunities exist, certainly there is, from what I'm picking, thriving demand for development finance, and in particular sectors like financial, to put money out on retail or offices is something of a discussion point. That said, when you're looking at development, it may seem counterintuitive that you want to lend money into a sector when there is so much disarray in the market. But I think taking a perspective of 2 years for a development cycle to be completed, you may well find yourself coming out on the other side of this down and the pandemic situation, and you can think about that as being an opportunity to lend to an environment where there will be a sense of normality once the development is completed and the product needs to be either let or sold. Clearly in residential you have 2 different, or maybe even 3 different opportunities. Obviously you can sell your units, you would be able to rent your units, or you may find alternate uses, although some of those alternate uses, for example, student accommodation is one of those sectors which I fear might find itself in a little bit more difficulty going forward, because universities ultimately might shift from a campus base to an online base for a lot of their courses. So I think you do have scenarios for some sectors like residential that could play very well in a short to medium term once we're in a much more stable environment.
I'll just share the results of that poll in terms of, I guess, where debt ranks. So does debt rank favourably on a risk-adjusted basis against corporate bonds? 37% said yes. Real estate equity, 63% said yes. And real estate public debt, 25% said yes. So that's quite interesting in terms of, I guess, maybe that preference for some investors to look at debt as an investment opportunity versus equity, which is quite interesting.
Maybe I mean jump in, because I have a very strong opinion on this, that this all changes the way we live and work, because some 25 years or 30 years ago I was told that that was a paperless office and that no one was printing anything anymore. And I haven't seen that since then. So more trees being cut than ever before. So same here. I mean, some people are happy that they can work remotely, and some had it for the first time. So there is a certain hype. But once you talk to the younger people, I mean, they used FaceTime anyway for the last 5 years. So they wouldn't say, okay, because I have FaceTime, I do not meet my friends. And they have Facebook, but they still meet their friends and they still travel. So I think it's an add-on and nice, but it will not fundamentally change that we want to be in an office because we need to meet, we need to see each other, collaborate. We want meetings and gatherings and fairs and everything, because this is the social element of us being humans. So I think that's not going to change. Yes, there will be add-ons and we might do more things at the same time than before. So I might not have to fly for a meeting for 40 minutes to London and back, which I've done in the past. Maybe not that one, but that doesn't stop me from flying to London. But then you do different things. So I think if you transfer that into real estate, we will get to a real estate world that we are used to. I'm certain of that.
I think Carsten makes a really interesting point. One of the things I think a lot of people have suddenly become aware of is that without the ability to be in physical communal contact with each other in an office or in a workspace environment, what seems to have happened is that people are now missing out on those casual conversations around by the coffee machine or the water cooler. People are actually realizing that the commute had value, as ghastly as our commutes have been over the years. It gives people an opportunity to actually start their day, if they want to, by planning on the way into an office, if they're, for example, on a train or a bus, maybe walking. And equally, when you leave an office, you leave the work behind, whereas people who are now working from home are finding that boundary has become not blurred, but has almost evaporated completely. Sorry, I'm mixing metaphors. But it does seem to be that the working from home concept has blurred the distinction between corporate life and private life. And that does have quite distinct implications for the way in which people behave and the way in which people are being able to be resilient in such times. We will want to return to an environment where people are together in offices, where face-to-face contact does matter.
There's a question here coming from CBRE. Thanks very much. Thank you for joining us from the Nordics there. The property industry entered the crisis in a good shape, and we can all agree it was neither a financial crisis nor a property crisis. However, there was a talk of an overheated market before Corona hit. In a few years, will we be looking back at this as a lost year or a brutal correction that marks the beginning of a longer market recession? How will that affect the view on risk? Is this a market correction that we were waiting for to a certain extent, and coronavirus just happens to be it? Or were we all really expecting the market to continue in the same route for 2020 as it had done in 2019? I suppose, what's your sense on that? Do you have any views on that, Jonathan?
Certainly from my perspective, in terms of planning for this year, I'd expected the year to look very similar, and as a business that's in a growth element, a growth phase, expected to see that as a good opportunity. So it did catch me rather by surprise. Will that lead to, is it going to be part of a correction? Will it lead to, I suppose that's the implication of that is distress in the market? Will it lead to distressed debt and situations like that? I've spoken with a lot of people about this to see what their thoughts are about restructuring and situations like that. And at the moment, the general consensus is it's too early to say, but the general feeling is that it will come. There's too many businesses have seen their revenues fall away, and there's placed a lot of stress on the covenants and loans, etc., that will lead to renegotiations and restructurings being required. So I think that will occur, that there will be distress. Is it going to be a long-term situation, or will we see a very sharp recovery? It's very difficult. It's very difficult to know. Sometimes I answer that with the conclusion that we'll see a very quick recovery when people start to get out. And then other times I think there's been so much fundamental change in the way that people are behaving that there will be things that people won't do. Will people want to go shopping and try on clothes that somebody else may have touched? Will people want to go to restaurants, which were relaxing environments, and they've ceased to be that because you're worried about how healthy or not somebody else is? So there's a lot. I'm an optimist, and I think there will be a positive recovery, and I'm optimistic that through the back end of this year we will see that, and perhaps we will return to something that looks more the way that we anticipated the year, but just for the last quarter of the year, perhaps.
Okay, good. There's a number of questions coming in, Norbert, and I'll just pick these up with you if I can. And these are all again around that sector idea, market evolution, office, senior housing, residential. How do you see these in terms of the short-term view as sectors? I mean, are you still actively involved in, for example, development finance for residential, or for, you know, are there areas that you're particularly looking at? And this residential one seems to be coming up a lot in terms of the Q&A coming in.
Picking up the one question you mentioned, Richard, about, you know, how do we see the impact also from on the risk perspective? I would like to add maybe one thing before I come to the asset classes again. I think a big difference to the past financial crisis is, in my view, that we, and again, I am optimistic. I've been, as many of us, for quite a long time in that sector, that we learned at least a bit. And I would say we learned a bit in a way that in our financings here at Berlin Huepfl, I can say we really, focus on much more equity, for example, from our borrowers to be involved in the financings. And in particular, when you just touched the development finance, I remember over 10 years ago, periods where there was almost no equity involved in a lot of these development projects. And that definitely changed. So today we are definitely focusing on that. We insist on having less leverage here. And the second point is also coming back to the covenant structures. In my view, we had a few years ago, in my view, a kind of a no good development when some, more remarkable players in the market, approached us that they didn't want to accept specific covenant structures, hard covenants, etc. And for the good, I would say, we were resistant, and we said, no, we need that, and that will help us through this crisis. Yeah? And then maybe coming back to your question, Richard, on the assets, again, I mentioned already that there are a few asset classes we wouldn't finance at the minute, or very, very selectively. Development finance, and in particular when it comes to residential developments, we think is definitely very, very interesting, because there is definitely the need for those kind of properties. I would say almost everywhere. In particular, I can speak for the German market. There is a need for that, and there's also, and we haven't touched that now or yet. Also, in our view from Berlin Huepfl side, of course, also a bit of the view that this is our aim to some extent as a part of the society here, to make sure that there is liquidity for those projects. And we think this is not only because we want to be good, of course we want to be good, but it's also that gives us an interesting impact on the way how we can refinance, because all these, let's say, financings in those sectors, I'm talking about, these sustainable projects, again, projects which have a huge impact on the society, will have a positive effect on the way how we can refinance our business. And in that regard, is also a kind of a win-win. And I think that is, to some extent, what we definitely will continue.
I mean, and that's interesting, because one of the key trends that we've been seeing coming out of this crisis more generally is, whereas before in the global financial crisis, sustainability kind of took a step backwards, really, and moved off the agenda, particularly for the real estate industry as a major topic anyway. I mean, it never went away, but this seems to be very different in that it appears to be an accelerator or driving that even more. So is that going to be something, Norbert, that you will be looking at even more closely in terms of your lending, that sort of ESG side?
Yeah, Richard, definitely. And I mean, Berlin Huepfl, we started with the first green bond, for example, in 2015. We continued with that. We are on a continuous way of increasing the number of green bonds we issue. And I think the ESG sector, I mean, there was a big debate of, how long will this last, and this is really important. I honestly think that in all this discussion at the minute about how, about social responsibility, how we cope with the pandemic, I'm pretty sure that in particular also for younger people, these aspects will be more important. And in that regard, I'm pretty sure that we at Berlin Huepfl will continue that. And I definitely think that also many other players will take this more and more into consideration to be involved here and to play a part in that area.
Okay, good. I'm going to pick that up with you in a second, Emma, but I just wanted to share the results of this one. Are you likely to allocate more, less, or the same to debt this year? More was 35%, less 37%, and the same 28%. So interesting there. Emma, do you see the sustainability, wellness, that aspect beginning to be much more influential going forward? What's your sense of that, particularly looking at the UK market?
Oh, absolutely. Real estate's been behind the curve generally on ESG issues for a long time, and it's now trying to catch up with the fact that tenants and investors who allocate capital to real estate want ESG compliant investments, and they want them now. But buildings don't adapt overnight, so there's huge work to do. And already we're seeing a valuation differential for assets that are environmentally superior. As a house, CBRE GI has a target of carbon net zero by 2040. On the credit side, we're working out how we can influence the behaviour of borrowers by creating minimum ESG standards within our underwriting and benchmarks for our portfolio, and looking at incentives through better pricing for green loans. And it's not just us. I chair the CREFC, the trade body for real estate lenders, and we're working really hard to try and create standards across the industry for real estate debt, and feed those back into the network, the Property Industry Alliance network, who are also working on the issue. So it's everywhere. It's been important for a long time, but real estate's finally acknowledging that.
Okay, good. And I've just launched another poll here, so it'd be interesting to see what the views are of everybody there, which is, which of these strategies currently look most appealing on a risk-adjusted basis? Core senior, senior plus, value add, special situations, and distressed debt. And it's interesting, it's looking like a trading floor in front of me at the moment as these votes come in with them adjusting here. But I'll share those with you all in a minute, but that would be interesting. And I just wanted to pick up, I mean, Anthony, just coming to you, in terms of lending, I mean, we heard there from Norbert, but also from Carsten to a certain degree about the amount of equity that people were going to be looking at. I mean, if a lot of the lenders begin to rebalance or rebase a little bit, does that mean there's going to be much more of an opportunity either for new players or for existing players to come in and I suppose meet that funding gap, if that exists? Do you think there will be a funding gap, and do you think that who will come in, I suppose, and meet that?
I think the point about the funding gap, I think, was made very clearly by Emma, and I agree with her that there are going to be fewer players, and those fewer players will have an opportunity to make the market more appealing for themselves by pricing accordingly, taking into account risks. I think what really matters is what is the opportunity set for new lenders to come into the market. And I think one of the areas that nobody really looks at the moment is how fintech might well become an even bigger disruptor. And the possibilities are that the fintech environment plays very strongly to a situation where there is less opportunity to go out and sell to investors and provide a more, I don't want to use the word securitized, but a much more homologated environment for investment product. And so there will be, I think, a growing opportunity set for investors to take advantage of different ways in which they can access the commercial real estate debt market for the private debt market. But see a situation where fintech would allow the flow of funds to come from investors through appropriate platforms. Obviously, they need to be properly regulated. I'm certainly not going to suggest there should be anything but a regulated environment, but to allow fintech to, if you like, ease the flow of funds through the system, ultimately to the borrowers. So I think there is a potential for a disruptive force in the market to come through. I think where the opportunities lie, as I think I've mentioned already, is definitely within the residential sector for development. It sounds, again, as I said before, counterintuitive, but when you think about the development cycle, it does present an opportunity where you can see yourself coming out of this environment of lockdown and concern for our safety and increased risk of because there may well be some sort of medical advancement that enables people to go out and buy or rent properties. The UK especially has a chronic shortage of homes. That does not go away as a consequence of coronavirus. And even more significantly, when you think that people are locked down in family groups, that actually poses a threat to concentrating the virus in family units of more than 3 or 4 people at a time. So if you have a parent and family grouping of 6 or 7 people where grown-up children and their children are all locked into one house with mother and father, then you have an increased viral uptake risk. So I think separating and dispersing populations through an increase in the housing availability stock may well be a good idea coming forward. Looking at how the market can continue to grow and expand, certainly I think the alternative lending market or sector represents an important development. It's not about can banks do or not do, it's about who should be carrying the risks.
I'm just going to share these results quickly with just in terms of the strategies currently look most appealing on a risk-adjusted basis. Core Senior is just out in front at 38%, then Senior Plus 27%, Value Add 22%, Special Situations 34%, and Distressed Debt at 32%. Do you see significant opportunities for high-yield mezzanine finance in view of banks becoming more and more selective? And a secondary follow-up from Mark as well. Any sign of the NPL buyers sharpening their knives? seems a good topic. Anybody want to pick those up?
I think capital for distressed debt has been raised for some time. There will certainly be interest in the opportunity. I don't think NPLs are coming through at this point in time. I think that credit is lagging the rest of the economy, and obviously the solutions that are being put in place in terms of interest deposits to get through the next 2 or 3 interest payment dates means that it's very unlikely we're going to see mass distress in the market this year. There's actually a very small mezzanine market in the UK, and that reflects the fact that people have been much more conservative about their use of high yield debt since the financial crisis. I think that we are already seeing senior debt rebasing down to a lower level from just the deal evidence I've seen to date. So if it's been trading at 60 to 65%, that might be recut down to 50 or 55% on the back of such uncertainty around where valuation sits at the moment. So arguably there is then higher pricing for that notional piece of, let's say, Senior Plus, which might have been funded by banks previously. Is there going to be significant opportunity to invest in high yield mezzanine? There wasn't before, and I don't think there is going forward on a widespread basis at this point in the European market.
One kind of last point which I wanted to bring up during this, how important is it going to be for the industry, particularly given that it's a no fault kind of issue, that there's going to be collaboration really between I suppose borrowers, lenders, the whole market in order to be able to make this work. And I suppose again from that point, are there any lessons that we learned from how it was dealt with in different jurisdictions in the last crisis, and whether or not there's going to be a more positive, I suppose, collaborative aspect to this? I don't know if you've got a view on that, Emma.
Yeah, happy try to answer that. I mean, communication is massively important, as we've already seen in the re-underwriting process that we've had to go through. Generally, I think there's a better relationship between debt and equity that arose out of the GFC. It was so traumatic for so many on both sides that I think everybody realised that fundamentally you have to understand why you're going into a relationship with a lender, and what drives their behaviours, what do they need to do to manage risk. So there's much better reporting and communication, as a basis anyway in the market. I think in terms of collaboration to find solutions, we've tried to make sure that the covenant amendments that we've made have been specific and for a fixed period of time. So we won't just agree to a blanket waiver, and we won't agree to something on the basis that our borrowers tell us that another bank is granting a 6-month interest holiday or whatever. Every loan's got to be very specifically considered for its situation. But we've chosen which borrowers we work with, and we absolutely want to collaborate with them to make sure that they can come out of this, if at all possible, unscathed and able to operate their asset as properly as soon as the market allows them to. So that's the basis on which we're working, and what we're hearing absolutely from other lenders as well.
Just in terms of the main theme that you see for 2020, I suppose the main short-term and more medium, longer-term theme for this particular market, designed to be a kind of 30-second answer, which I know is quite difficult in this particular case. But let's start with you, Jonathan. Just in terms of, I suppose, what you expect to see as some of the key trends.
I think from my perspective, what I'm interested in and I suppose excited by is to see what happens to government debt and how that prices. So as the market gets flooded with more debt, what the Bank of England actually does, how this impacts on monetary policy, whether it looks at negative rates, and the implications of all this, and then what happens to inflation. So those are the things that are of interest to me, and I'm sort of looking forward to with excitement as such. And my opinion on what might happen varies almost on a daily basis as to whether we're going to see inflation, or whether we'll see negative rates, which is an implicit inflation. So giving a view as to what will happen, I'm going to step away from that one. But the things that interest me are government debt and inflation.
Fully agree with what Emma just said, and maybe that brings me to my key trends I see here. This is a time for cooperation. We will see a lot of combinations with long experienced partners who make things possible, and we will see that maybe the weaker areas, the weaker asset classes will be difficult to get financed, will be difficult to let's see, get realized. And I think last but not least, in my view, I mentioned it at the beginning, COVID-19 is, let's say at the minute, really a kind of an accelerator of processes we've already seen beforehand. So I think, a bit of what we expected to come maybe over the next 2-3 years will come a bit earlier.
I think Norbert's comments, Emma's comments are absolutely spot on. My betting is we will see a continued radical shift on the demand for retail space, quite obviously. I think office space is going to come under some significant question now, both in terms of occupation going forward in the short term and demand going into the medium term. I think serviced offices might well see, again, counterintuitively or contracyclically, an increase in demand, because people won't want to necessarily have fixed office space, but they may well be willing to have space available at short notice or for shorter periods of time. So I think we may well see a stabilisation of the serviced office space market. I've already spoken about residential. I won't expand on that any further. I think there is an important thing to consider where student accommodation may well shift in what might have been a long-term trend driven by the online presentation of courses. Clearly, universities will offer online courses where they don't have to have campus activity, like for laboratory work in the sciences or for workshop activity, for example, in design or other creative products. I think the logistics is clearly having its day. What happens after all of this is over is very much open to debate, and I can't predict that. In terms of interest rates and in terms of inflation, I think what is difficult to talk about now is where they're going to go. Clearly, we will have a long-term lower interest rate. How that impacts inflation, I can't yet predict.
Yes, I think what comes up is that there's even more state debt than in 08, and we will probably all not see really high interest rates in the long term. So that must, and if you fear of inflation, then that must drive investment into real assets, which is shares and real estate. So, and there is this immense liquidity out there, which then needs to be invested, and we basically haven't seen so many investments for some months now, maybe some more months to come, but then this will all come at the same time, and that's the issue that we had before, not enough product for a lot of money.
Key trends in the debt markets this year: borrowers are going to have to work harder to secure the finance that they need. I think things will take longer, ticket sizes will be smaller, and some sectors are going to be very challenging to finance. I think we're going to see interest from new investors in debt arising from dislocation. So we'll see the emergence of new players, but others may quietly withdraw back to their domestic markets. So definitely a changing landscape in terms of participation.
Okay, interesting. Thank you. I just wanted to say thank you to everybody for joining us. You can register now for upcoming events, download presentations, editorial, video content from both this and other briefings on our website. Upcoming events, we've got the 2nd of June, European Logistics, and that one's particularly looking at e-commerce, supply chains, investment locations. On the 4th of June, we've got senior housing and healthcare. And actually interesting, there was a lot of questions around the student housing sector, and we've got a session on that later on in June. So please do book in for those if those are interesting. Thanks very much to all of the speakers. It's been an absolute pleasure this morning to discuss the market with you, and thank you to everybody who's attended for your questions and also for engaging in the polls. I think there's been some really interesting and valuable information shared today. So thank you very much, everybody, and look forward to joining you at the next one. Thank you.